Welcome back, guys, to Road to Success. I'm here with my co-host, Andrew the Bull. And today we're going to be talking about everything you need to know if you are a first-time homebuyer.
Absolutely.
So, Andrew, if I'm a first-time homebuyer, how long do I need to be at a job before I can buy a house?
So what we look for is 2 years of employment. Now, a couple different things go into that as well, but generally speaking, if you're a W-2 employee, hey, receive a W-2 at the end of the year. Most employees are kind of structured that way, looking for 2 years. Now, a lot of people always think, oh, I have to be at the same job for 2 years. Not necessarily. Now, I'm not saying have, 10 different jobs in 2 years, but same line of work, different things like that. 2 years, different jobs are okay. And we'll just have to show all that on the application.
Yep. And then some things do go into it, right? Where, hey, if you just changed from salary to commission, if you are now receiving bonuses that you want to use, maybe they're large, those are things that do have to have a 2-year work history, especially if, like, for example, I have a client right now. He's a truck driver. He doesn't just get paid by the hour. He gets paid mileage or load pay, right? So now we have to have a history of that. So sometimes you can get away with a year, but for the most part, you need 2 years. Now, there is a little bit of a trick question there because you could potentially buy a house without ever starting your first job.
That's true. So that would kind of fall into if you were a full-time student. Went to college, got out of college, got your first job, offer letter even, something in the field you went to college for. College, if you are a full-time student and you did graduate, we can get transcripts for that. Does count as employment.
Or even vocational school because, for example, let's say your electrician's course is a year long. Well, now we can actually use the 1 year of high school, right, as work history. So all your high school counts as 1 year. And then if you did a year of, technician school of whatever that trade is, if it was a year, now you have 2 years work history, and we just need some sort of letter, offer, or something that's going to say what you're going to make. And that also depends as well, because if you get an offer letter and it says you're going to be hourly, well, we can't use that. But if it's salary or it specifically states, like it's a contract, like you will work this amount of hours no matter what, then we could possibly use that.
Yeah, absolutely. Now, Violi, let's say I was working at Primary Residential Mortgage, W-2 position, but hey, I just started my own job, just kicked it off last month. Tell me a little bit about that. Can I buy a house right away?
So we could potentially use your primary residential, right? Because maybe that's a W-2 job, but because you just started working for yourself, until we have 2 years of W-2s, we can't use that.
Yeah, got 2 years of federal tax returns what we're looking for a self-employed employee. So if you go from W-2 to a contractor work, 1099, anything that you're going to put on those tax returns at the end of the year, we need to see a full 2 years of being self-employed. Doesn't matter if it's the same field or anything, because once you get into receiving 1099s, even if you don't necessarily work for yourself and you're a contractor for another company, they still consider that self-employed income, in which we would need 2 years for.
Like, so one time I had a client who he is a dentist, and he was like, hey, I have this W-2 job and I also have this 1099. Can I use the 1099? And I said, well, let me see your taxes. And he was like, well, I just started working this one a couple of months ago. Well, you're not going to be able to use both of them, and we're not going to be able to use the 1099 because you don't have 2 years of receiving that pay. So if you want to use the 1099 because maybe it's higher, then we're going to need, sometimes, like I said, sometimes we can get away with a year. It just really depends on your scenario. But for the most part, it has to be 2 years, or at least 2 years in the same line of work.
Exactly. So the short and simple of what we're trying to get at here is employment-wise, 2-year history. Whether that be a couple different W-2 jobs in the same field, hey, you're young, maybe you're finding your way, Self-employed has to be 2 straight years with the same business, but roundabout way, what we're saying is you need 2 years of employment.
And that's what you need for your work history. So that really sums up a lot about working and what can you use. Like, I think one last question probably in employment is, I just started this other W-2 job and I have a W-2 job. Can I use both of them?
And that pops up quite often. I have a client right now that's been working 2 jobs for about a year now. And when it comes to that, we can't use both unless you have a 2-year history of working 2 different jobs. If it was 3 jobs, it would be the same way. You'd have to have a 2-year history working 3 different jobs. So what we do in those scenarios is generally we're going to kind of pick, hey, which job has more income to use, more qualifying income there. But if you're just going out and, hey, I don't quite qualify for this, maybe I'll pick up a second job and that'll help. Not quite. And I have a strong suspicion that's exactly why that guideline's in effect there.
And think about it like this. 40 hours a week, salaried, is normal. Anything that's not normal, aka overtime, salaries, bonuses, any type of 1099 income, anything that's not normal, out of the norm, then you have to have a two-year history of receiving that type of pay. So just remember that if it's not normal, which 40 hours a week is normal. Now, maybe in your field it's different, right? There are some fields where like, hey, it's actually normal to work 50, 60 hours a week and things like that. But in general, right, just think about it like that. Normal is 40 hours a week. Anything other than that, if it's less, need 2 years, because now we got to average out your income. Sometimes, again, you can get away with less, but for the most part, you need 2 years of working and receiving that type of pay. So going along with our, what do you need to know if you're a first-time home buyer, the second part will probably be credit.
I'd even argue that's the first part before income. So the first thing we do is when we send an application, everybody fills one out and submits it back to us. Credit is the very first thing we're looking at. And we're not just looking at the credit score, also looking at the credit profile. What kind of debts you have, what kind of payments and monthly obligations you have in total there.
Right. So credit is the most important thing, because you can make all the money in the world, but if you don't have any credit, no one's going to lend to you. And it's not our fault. We would love to be able to lend to everybody.
That's very true.
Approved. Right? But it's not up to us. We have to cover these guidelines. And what I like to tell people is, listen, these rules are made by the government for a reason. So 2008 doesn't happen again.
Yeah.
So when it comes to credit, you have to be very careful with what you do. You got to take care of it like a baby. And there are some things that you can do to improve it in the short run, right? Making sure that you're paying all your payments on time, making sure that you're not late, making sure that you're only taking out new credit that you absolutely need, and making sure that you're not closing any accounts. That's really huge. I mean, I've seen some people go from a 740 to a 680 because they closed a credit card.
Yeah. And another thing I see that's huge too is high balances on things. Hey, a car loan, they're not really a high balance on that. Yeah. That's an installment loan. But I see people all the time that, hey, if you didn't have 3-4 maxed out credit cards, your score would be nearly 100 points higher at times.
Yep.
So something just to use credit wisely. And the biggest thing is pay your bills on time and don't try to have too many maxed out credit cards out there. Hey, this day and age, easier said than done. Yep. But I think that's kind of the 2 biggest things that really have a big effect. Then we can kind of really get in depth into, collection accounts and things you didn't pay and late payments and things like that. But the short and simple with credit is that's the first thing we look at. We're going to look at the score, and that's what I mean by your credit profile. How long have you had credit? How many accounts do you have? Are the accounts maxed out? And then we take all of that information, and what we're going to do is look at your total monthly obligation, meaning minimum payments for everything. And that's kind of what we use to get what's called your debt to income ratio. You want to touch a little bit about debt to income ratio?
Yeah, so when someone asks me, well, what can I buy? We kind of have a rough idea, right? Because there's some guidelines and rules that we kind of know that for the most part, if someone has pretty good credit, it's probably going to be somewhere around 50%. Could be less, could be more. And when I say 50%, it's what your gross pay is. So if you make $4,000 a year, banks are saying that they are willing to see that you have a maximum total debt of $2,000 bucks. So if you are looking for a home, that means that's the absolute maximum payment you could have. However, if you have a $500 car payment, that $2,000 bucks now just went to $1,500. If you have credit card payments that are 25 bucks here, 25 bucks here, 30 bucks here, 50 bucks here, 70 bucks here, that's $200, right? So now you just keep bringing it down and down and down. So your debt to income ratio is going to have a big factor in whether you're going to get approved for a house, no matter how much you make.
Yeah, and a big thing as well to take into consideration when we're coming up with that debt to income ratio, we're looking at debt, not just your current debt, but your future debt, meaning the proposed housing payment.
Mm-hmm.
We're adding those together, comparing them to the income to get that entire debt to income ratio. Now, your current debt, yeah, you can do some things about that sometimes, but that's fairly set. That second kind of piece of the puzzle there is your future debt, the proposed housing payment. That's what's going to change. That's what's going to tell us how much of a house you can afford, how much of a house you can qualify for.
Now, Andrew, my brother, and I don't, but my brother, I took out a car loan for him, but he pays it. Do you still have to count that against me?
100% I would have to count that against you if it's on your credit. Now, the exception to that would be if we were up against the wall here, we would need 12 months proof that your brother has made that payment. And it can't be a joint account with you and your brother's name on it, anything like that. We would have to have a full 12 months of his bank statements showing that he has made the payment to that to exclude it. But yes, I mean, that pops up a good bit. Hey, I co-signed for something. If it's on the credit report, you're still liable to pay that. So we would have to count that against your debt to income ratio.
And don't think you can go around that by just saying, hey, bro, pay my car for me. I'm gonna sell you the money, because that's what we're looking for. We want to see, that's why we want 12 months of bank statements. We want to see, did you send your brother the money and it's coming out of his account, but it's actually, you're really paying it at the end of the day, right? Or if you took it out cash and you gave it to him, and then all of a sudden every single month, the same date that you put it out cash, you're giving it to your brother, it's a red flag, right?
Yeah.
Look, we're not going to call you a liar, but you're going to have a very good excuse why on the same day for the last 12 months, you take out $1,100 and you give it to your brother and he deposits that. Maybe there is a good reason for that. Maybe that's the rent payment and you're giving it to your landlord, and we can prove, hey, it is every on the first, and then the brother maybe is depositing $1,100, and his reason for that every single month is because he actually gets paid cash from some sort of business that he can prove because he has a letter, and now that's completely legit. But if you want to give your brother the money to pay for it, or your sister, or whoever you want, it's not going to work.
No, absolutely. And I mean, this entire industry is just about checks and balances, documentation. I mean, if somebody got a little creative, we'll call it, before in the past, you can bet there's a guideline about it out there to prevent that from happening again.
So we've touched on employment. How long do I have to be at a job? We've touched on credit, the most important thing, right? What do I do to take care of it? What are some things that I can do to make sure that it's good, right? What are the things that we're looking for when we're looking at credit? So probably the last thing, assets. So Andrew, what are we looking for when we're looking at assets?
So when we talk about assets as well, I mean, it's not just, hey, your total assets, meaning things you own of value, anything along those lines. Your car's not an asset unless you sell it. But what we're talking about when we say asset is show me the money in the bank, anything that you have within your bank accounts to use towards the transaction of qualifying for a mortgage.
401ks, savings accounts, checkings accounts, 203Bs, whatever that you can like get your hands on, right? That if you need
Liquid funds, yeah.
right, liquid funds. If you can get your hands on it and it's in your name, you can show us a statement. That's what we're looking for, right? Sometimes we need reserves because maybe your debt to income ratio was pushing it. Maybe you got up to 49 or 50%, right? And it was pushing it, and maybe your credit wasn't so great. Now we're gonna maybe need a couple months reserves. That happens sometimes where, if you're buying below your means, sometimes you don't need those reserves. But sometimes if you have bad credit, you're buying at the maximum that you can possibly have, those things will affect it.
Yeah, and help you out as well. But the short and simple about assets are, we're just looking for, hey, do you have funds in the bank that are sourceable? And generally when we say sourceable, and what we're looking at is 2 months bank statement. What an underwriter and what we're going to look at is, hey, this guy has, $30,000 in the bank, but a month ago he made a random cash deposit of $25,000 at a branch.
Where'd that come from?
What is it? Mm-hmm. Exactly. Has to be usable funds. So a lot of people sometimes, hey, you might not have all the funds, and maybe, hey, my mom said she would help me out. Tell me a little bit of what goes on with that, a gift.
So if you're getting a gift, right, so those are some assets that you have, right? If you're getting a gift, we can put that in the system, and it calculates it as well, right, as usable funds. And your gift, depending on the program, we might need a bank statement from that person. And that bank statement, we're going to verify that those funds were either already in there or that they have a reason that they just deposited that money. Because what we're really looking for is to make sure that all these funds came legally, right? That you had a use, that it came from somewhere, whether it was a loan from somebody, right? Or whether it was that you had it, and because every single month, and we can show it using your bank statements, you take out a certain amount, and because maybe you don't like to have too much in the bank. Totally fine as long as we can prove it. But if we can't prove it, we're gonna have to wait. We're gonna have to, have seasoned funds, which is 2 months. Yep. And if it's a gift, it's just 1 month. But there are scenarios where there are gifts in certain programs where you don't need any bank statements. So it just depends on the program that you qualify for, what you're buying. So the most important thing is get with a professional. The number one thing is get with us, ask us the questions, find out what you can afford, how much you can buy, and keep it moving. Now, going on a little bit more for the first-time home buyers, what if I don't have all the money? I only have the money for the down payment. I don't have the closing cost. How much is closing cost going to be, Andrew?
So really depends program to program, but in general, closing cost on a loan, looking anywhere from 4 to 6% of the total purchase price, generally what I like to tell people. And people kind of get confused about, hey, down payment, closing costs, things like that. And in this industry with all my clients, what I like to refer to it is cash to close.
Yes.
And what I mean by cash to close is that's the down payment, all the closing costs wrapped into one, total out-of-pocket expense. That's what you're going to need. Because there's no sense in talking about the closing cost and the down payment when at the end of the day, you guys need to know what you're bringing to the table.
So cash to close is everything you will need to buy a home. Closing costs are, things like appraisals, transfer taxes, things along those lines. Now, down payment is simple. It's just your down payment. But when we're talking, right, you want to ask that. What is your cash to close? Because that's what's going to be important. That's the number you really need to know. And, sometimes people don't have the money. So we have programs, and depending on the program, right, you can get the full 5% or the 3% or whatever the case may be. So, we have to find out first, what is your situation so that we can know what program can they go into. Can they qualify? Maybe they need to get their credit up because some of these programs have minimums, right? And keeping going with that minimum, sometimes we get clients that ask, hey, I have a 550 credit score. Can I buy a house?
And technically, yes, you could. But what they're going to look for is compensating factors. Low debt to income ratio, high down payments on certain programs and things like that. So in general, yes, I mean, you could, but the first thing we're going to kind of look at is, why do you have a 550 credit score? Is there things that are easy to kind of repair that credit score? But in a roundabout way, there's really the big three we're talking about here. There's credit, income, assets. And that's kind of the steps we look at as well. First, we're going to look at the credit, then we're going to look at the income, make sure everything's good there, and then last but not least is the assets. And you touched on this a little bit earlier though, but let's say, hey, I have a decent credit score, I make enough money, my debt to income ratio is pretty decent, first time buyer here, but I don't have enough assets. Can you go into that a little bit? Like, what kind of programs are out there? What, kind of go into them, credit scores and income and things like that?
So it really is going to depend on your state. So, in our company, we're nationwide except for New York. And it's, like I said, it's going to depend on the state, but for the most part, you've got Chenoa everywhere, right? That's a down payment assistance that can go up to 5%. In Maryland, we have the MMP that can also go up to 5%. And they even have a program called a Smart Buy that they will pay up to $40,000, which recently changed. It used to be 50.
Used to be 50, yeah.
And they will pay up to $40,000 of your student loans. Now, anything over that, you have to come up with a difference. But that's a pretty good program. Not only are you going to get paid for your student loans, but you can also get 4% with that program for your closing costs.
Yeah.
So, you have the down payment, you have the 4% for the closing costs. You might not need a lot more in a situation like that. So, in another thing too that some people need to know is all these down payment assistance programs, they all have their quirks, right? They're not free. So if anyone ever says it's free money, it's not. Nothing is ever free. We know that, right? So remember, you have to find out why. Don't just, because a loan officer said, hey, you're going to get this money. Okay, well, what's the stipulation, right? What's the difference? Because if you have all the assets, you have all the money to buy this house, and then you want to just go and try to use every single program, every single grant there is, you could get burned. And it's happened. It happens all the time because these programs sometimes run out of money. Those grant programs, like for example, the Baltimore City sometimes has these grant programs. I know there are some borrowers that are like, well, I have no money. I'm using this for the down payment. I'm using that for the closing costs. And now this program just ran out of money. Well, guess what? That earnest money deposit, which is the money that you give when you're, saying that, hey, I'm under contract. I promise I'm going to buy this house. You could lose that, right?
Yeah.
You could potentially lose that, and that could be, it could be $1,000, could be $3,000, could have been $5,000, could have been
generally
10.
1% of the purchase price, what you're looking at for that. But yeah, I mean, the short and skinny of it, I think you hit the nail on the head there. Like, yes, these programs are out there. I'm never going to recommend them to somebody unless they need the program. I have people calling all the time that have their own funds, everything like that. Well, I want a first-time buyer program. I always kind of walk them through that. Like, yeah, I mean, they're out there, but there are kind of stipulations to them. You're taking a higher interest rate. Your monthly payment's going to be higher. If you ever go to refinance or sell that property, you're going to have to pay that money back. So it is very, very handy to have and very good for certain people, but it doesn't make sense for everyone.
Right. And that's the thing. You just have to get with a professional, not just someone who's gonna tell you, hey, here's this program, but someone who's actually gonna look out for you, someone that you trust, and that when they tell you something, it's accurate, and that they're out to do what's best for you. Because sometimes the way to close a loan the quickest way, it might not be what's best for you, but you want someone who's gonna tell you the truth and tell you, hey, if you take this program, you're gonna have to be in here for 5 years. Some programs even 10 years, right? You can't sell, refinance, or even think about, transferring that house to someone else or moving.
Yeah.
If you're under that 5 or 10 years, because what happens is they're gonna want their money back, and that's the last thing you want, right? Is God forbid there's something that happens to you, and you got into one of these programs and you didn't have the money before, you don't have the money now because you don't manage your funds wisely, and unfortunately they're going to want their money back.
Yeah, but that's a good point. I mean, it's at the end of the day, it's why you speak to a professional. It's Not anything we're ever going to recommend. I've talked people out of using first-time buyer programs if it's not right for them. I mean, hey, you have the money, you have plenty of there, you know, if we're never going to try to have you use all your money to get into a house, because that's not going to set you up for any success there.
Yep.
You know, you're going to be house poor. But I've had so many people inquire about these different programs and stuff like that. I'm like, at the end of the day, it's, you know, that might not make a lot of sense for you.
Right.
And it's just important to speak to somebody who knows the ins and outs of every program and every situation. That's what we're here for. We're going to take a look at the credit, the income, the assets, and we're going to kind of try to guide you and show the pros and cons of what's available out there for you and what we think best matches your scenario.
So, I mean, if I'm a first-time home buyer, I feel like I've got every single answer to my questions, right? How much money do I need to have, right? We just said it, right? You need between 3 and 6% for the closing costs. You need between 3 and 5% for the down payment, right? So that's going to be anywhere from, we're talking about 6% to up to 10%, right? So if that house is $200,000, you might need 20 or a little bit more, right? Mm-hmm. So now you know how much you need. You know what to do with your credit, right? And something that we didn't say before, but listen, if you're in a situation where your credit is that low, like your credit is super, super, super low, it's, as much as we're professionals, right, we're going to point you to someone who's a complete professional in credit. Someone who that's all they do. Because if you're in a jam, you need the best, right? And you don't want just someone who knows a couple tips and tricks. And we know tips and tricks, and we're good on credit. We see it every single day. But if you are facing a situation where you have disputes and collections and things that shouldn't be there, and maybe you want to negotiate some of those things, you need someone who can do that for you on a full-time basis.
Yeah,
so,
the hard fixes, as I like to call them. You
right.
know, we can look at a credit report. Sometimes there's some pretty easy, hey, pay that card down. That's an easy fix. That should definitely help you out. You know, maybe pay this card down as well. Little things like that, easy fixes. But that's dead on. And I'm kind of glad you brought that up as well, you know, with the credit professionals and people with lower credit scores. I speak to so many people that are like, hey, I'm thinking about buying a home, but my credit's nowhere where it needs to be. Like, I'm not going to waste your time. You're not wasting our time. If your credit's bad and it's nowhere close to being qualifying or where you think it needs to be, get with somebody. Let us take a look at the credit. Let us build a kind of pathway and a plan to work on that for, hey, it may take 3 months. It might take 6. It could take a year or over a year sometimes.
But Andrew, I'm afraid that if I call you and I say, hey, can you check my credit, that my credit score is going to go even lower.
And that's definitely a possibility. It really depends on a lot of different factors on how hard that hard hit's going to hit your credit. Mm-hmm. But I tell people all the time, hey, even if it's going to be a couple points hit to your credit, we can usually point you in the right direction of getting over that couple point hits and even further than that.
And the thing is, doing a credit check is going to hurt you about 2 or 3 points. You know, and sometimes it could go up to 5. Right?
Yeah, I've seen it a little over, but I've seen it under 2.
Right. So, for the most part, you're going to be okay because the difference in rate and the difference in what you can qualify for is every 20 points. Every 20 points has like a different rule, like, hey, it's a little bit easier. So you could be at a 619, but that 1 point makes a difference between maybe you being able to buy 400 and 475 or 450, right? So all those things come into play, and you know, income, assets, liabilities, right? We've talked about all of that. So I mean, if I'm a first-time home buyer, I pretty much have every answer to every question that I could possibly, you know, have. So if you guys have any other questions about, you know, buying a home, anything like that, put in the comments below. We'll respond to you, and you know, shoot a message to us. We're always available, right? That's the thing about this industry. You're always available.
Yeah, absolutely.
And I'm Vialdi.
I'm Andrew.
And this is Road to Success.